that was... All right, thanks everyone for coming tonight, and thankfully it's just raining, not snowing, so it'll make it a lot easier to get here. I'd like to start by introducing myself. My name is Ted Parkhill. As I mentioned during the brief introductions, I run a systematic investment firm in Incline called Incline Investment Management. I feel I'm somewhat qualified tonight as MC and as the introduction of our guest speaker, because I too run a brand new crypto fund, but it's a little different than the guest speakers. We run a actually futures crypto Bitcoin product. So anybody is interested in talking to me about that afterwards, I'd be happy to talk to them about it. It's quite different than what our guest speaker does, at least I think so at this point. The other thing I'd like to do tonight is, and this is often overlooked because he's not here, but because Johannes is here, I'd actually like to just recognize Johannes as being not only the founder, but just a die-hard regular at these meetings. And I know that I'm filling in and will be going forward, but Johannes has done such a great job of getting this whole program going. He has kept it going. And I'd just like to thank Johannes for doing such a great job. And I'd encourage everyone, sort of round of applause to Johannes and his effort. And don't tell him we don't do that when he's not here. All right, so the next thing I'd like to do is just to acknowledge our sponsors, because as Johannes said earlier, it's really an important factor for keeping everything running. And starting with our major benefactors, we've got New Leaders. For those of you that don't know, they are a web application developer and mobile app developer. And the really cool part is they're here in Truckee, as I like to say. I don't know why I say it so many. Then we have Holland & Hart, a law firm. We have a number of law firms that sponsor us, which is nice to see. We've got Mobo. And I think, if I've got this right, Dana McDonald is here tonight from Mobo, which is nice to see. We have Bob Buchanan as well from the Buchanan Law Group. I don't see Roger here. He's often here. But Roger Khan, whom I know from Incline, is the new, he's developed the new Mountain Workspace out of Incline, where Tahoe Blue used to be, or Porter Sports. So look for Roger as well. That's an up-and-coming space. And then our community partners as well. We've got Justin Sweat, who made a couple announcements earlier from the Truckee Chamber of Commerce. The TTC TV gentlemen are here tonight. We have Payet, the Lyft co-working space, Pizza on the Hill, which we always thank as well, and Truckee Roundhouse, which is, I think, a makerspace. So check that out if you don't know about it. So thanks to all of our major sponsors. Thank you very much. And now, what I'd like to do is introduce our guest speaker tonight. We have Jesse Myers. And Jesse Myers is, well, let's put it this way. He didn't go to any of these safety schools by accident. He started his undergrad at USC. He then did his master's at University of Texas at Austin, and then really slipped and went to the Stanford Graduate School of Business to do his MBA. And I think Johannes might have spent some time there doing a PhD, perhaps. So that's his background, but he is also, and more importantly, the principal of Protocol Capital. Protocol Capital is a cryptocurrency investment fund based in San Francisco, and he first learned about blockchain and began personally investing, which then led him into developing his own firm. Tonight, he's going to explain the potential of blockchain technology, how it can disrupt the traditional industries that profit from non-blockchain transactions, and how you as an individual or business owner or an investor can leverage it. There's a lot of interest in this topic. In fact, just before Christmas, I traveled to Korea to speak at a cryptocurrency event. There is tons of interest, not only here in the US, but internationally as well, for a lot of reasons that I have a feeling Jesse might touch on. And so it's fantastic that you're here, and with that, I'm going to turn it over to Jesse, and thank you for coming.
Thank you very much. Thank you, everybody. Thank you all for having me here. I'm amazed to see so many people here, and I understand over in the overflow room as well, and on YouTube, so thank you, everybody. I run Protocol Capital. We are a cryptocurrency hedge fund, an investment fund in San Francisco. And I've been in the space for a couple years personally. I got interested in it when some of my more technical classmates at Stanford were buzzing about it years ago. And started the fund in July. It's been running since October. But today, what we're going to do is talk about what is blockchain. So, Bitcoin has been all the rage the last few months. I'm sure everybody has talked about it at least a few times at this point. But not a lot of people know what it really is or how it works. And so we're going to do a very stripped down simulation in this room of how the Bitcoin network works. And so hopefully that will shine a little bit of light on what it is and what this technology creates out of thin air. Once we've done that, we're going to talk about what that technology can then be used to do and why I believe, and many people like me believe, that this will disrupt a large number of industries and really change the way that businesses execute their transactions and contracts today and in the near future. OK, great. So what is a blockchain? We're going to do the scenario here of running bit dollars, which is basically Bitcoin. And we're going to see how, through the contributions of independent actors, which are going to be you are the bit dollars network, we're going to create Bitcoin, essentially, and see what sort of value can be achieved through your independent contributions. So the scenario here is we are all users. We are all part of the bit dollars network. And some of us will be sending some transactions during this simulation. So we're going to simulate 3 blocks in the blockchain. And so what is a block? It's really just, in Bitcoin's example, a 10-minute period of transactions. So all the transactions that happen in that 10-minute period is a block. And then we're going to be using our miners, who I picked 3 of you in the room to be our miners, who are going to be listening to transactions and updating the ledger, the bit dollars ledger, based on the transactions that they hear. And this will all make sense as we go along. So to start, this is our ledger to start, where we have everybody here has an account on the bit dollars ledger. It's really just a spreadsheet of how many bit dollars you own. And let's say at this point in time, we've got these 4 users who are going to be sending transactions. And at the start of block 1, they each have 100 bit dollars in their account. Now we're going to see some transactions that are going to be broadcast by these users on the network and then listened to by the miners and incorporated into their updated balances for block 2's starting ledger. Now, the one thing I haven't told the miners that there's a few rules about what kind of transactions are valid. And the 2 that are going to be relevant for you is that a transaction is only valid if a person has that amount in their account to send at that time. And the other one is that it has to be signed by the person that is sending the money. So if those are not true, then it's not a valid transaction. And again, this is a really stripped down version where we've taken out all of the more technical elements of a blockchain. But this is, at its core, what is happening. So with that preamble, let's hear from our users. Who's Alice, Mark, Bill, and Judy? We got 2. There's 3. And then over here, you're Bill, right? OK. Right, great, excellent. So who has any transactions that they'd like to send in block 1?
Alice sends Mark 10 bit dollars signed Alice.
OK, great. So miners, you all heard that, right? Alice sends, yes?
Alice sends Mark 10 bit dollars signed Alice.
OK, great. Are there any other transactions in block 1?
Bill sends Judy 40 bit dollars signed Bill.
OK, awesome. So I think that's it for block 1, right? So miners, if you could update your balances based on what you just heard, And then here's the key to how we create consensus in bit dollars or in Bitcoin. We're now going to listen to the miners who have updated the ledger and hear what they suggest the balances should read. They've independently calculated this, and they're going to vote on what the balances should read at the start of block 2. So if we have a miner to suggest what it should read now, that would be awesome. Any bold?
And while you do the complicated calculation, we may be running out of oxygen at some point. So if we can temporarily open the door a bit or some windows, could be open there.
Running out of oxygen. Okay. All right. We have a miner here. So we've heard these transactions, and now our miner is going to update us.
We have Alice has 90, Bill has 60, Judy has 140, and Mark has 110.
Okay, great. Do the other miners agree with that?
I can confirm that.
Okay. All right. So we have 2 out of 3, and we've got 3 out of 3. Great. So that's the consensus that the miners have come up with, and as users, we're all satisfied that there's consensus among these independent actors. So we believe that that is what our balances should read. So it's key here that when I put this up, that's not the right answer. The right answer is what you all decided upon. I just guessed in advance because it's simple math. But if you had agreed that it should read something differently, that is how it would read, because we're agreeing on consensus. And again, this is a very simple scenario where we only have 3 miners. In reality, we would have many, many more. And so we would have a consensus based on a computer script automatically capturing all these transactions and in a pretty fail-safe way updating the balances from thousands of different miners. So it starts to get very secure in the fact that you can trust what the consensus is. So great. So we've got our starting ledger for going into block 2. Do we have any transactions in block 2? Yes.
Judy sends Alice $530 signed Judy.
Oh, we broke a mic. So Judy sent Alice $530 signed Judy. Do we have any other transactions?
Mark sends Bill $50 signed Mark.
Okay. And is that it?
Bill sends Alice $10 signed Bill. Bill sends Mark $20 signed Bill.
Okay. So a fair bit of math there. But in there we saw that Bill sent multiple transactions in that block, but that's fine because he has that in his account. There was another very large transaction in there though, and we'll see what the miners do with that.
What if the miners miss one of the last transactions?
Well, we can. Well, would you like to hear it again? Yeah. What was the last one? The last one or the second to last one?
The last.
The last one was Bill sends Mark $20 signed Bill.
How do the miners feel? Are we? Takes you back to elementary school, right?
Do
Yeah.
they get the reward?
What's that?
Miners, they get the reward?
Well, you're right. I should say that the way this actually works with Bitcoin is there are 2 rewards that the miners receive. They receive the transaction fee for any of these transactions. So in theory, there would be a tiny transaction fee included with your transaction to incentivize the miners to include it in the block and process it for you. There's also the way that new currency is introduced into Bitcoin. So there's an inflation schedule of, at first there were 50 Bitcoins per 10 minutes that were introduced, then 25, 12 and a half. It halves every few years. And the miners get basically if they are in the consensus opinion, they get a chance to win that reward of the new coins that are created. So it's very lucrative to be a miner today because of the high prices of Bitcoin, which is why there's so much energy consumption, because so many people are contributing their computational power for a chance to win that very lucrative reward. Okay, so miners. Do we have?
From my computational power.
Okay, yeah. Let's see what you
In my
spooled
head.
out.
Let's see if I get this right. Alice has 90, Bill has 30, Judy has 140, and Mark has 80 because the first transaction was not valid.
Okay, other miners, do we?
I got, Alice has 90, Bill has 80, Judy has 140, and Mark has 80.
Sweet.
I'm still very close to working, so Alice has 100.
Let's jump ahead and just. Yeah, this is what you got, right? Yeah. So yeah, we might have made it a little too complicated. So the key here that I just tried to include is there are certain cases where a transaction is not valid. In this case, Judy did not have 530 BitDollars to send, so when the miner saw that, their program that's running on their computer would automatically see, nope, that's not a valid transaction. We toss that out. So you can't go negative. It's a debit card. It's not a credit card. So that's a key requirement of this system. So and then finally, block 3. We'll just jump ahead. That in this block, we were having Mark send on behalf of Judy, which is not allowed. Obviously, these transactions need to be signed by the person sending them. The signature is actually a very complicated and elegant digital signature that uses cryptography such that it's impossible for you to falsify it unless you have that person's very long password in hand. So in this instance, this wouldn't be a valid transaction because it didn't have the password attached to Judy's account, and therefore it would trigger a red flag and be tossed out. And so this is, as you can see visually, this is a blockchain where we've chained together these blocks based on the transactions that are in them, but importantly, the snapshot of the ledger each 10 minutes that we come to a conclusion, a consensus about through the consensus of the miners who have been keeping score through their independent contributions with the incentive that they have of potentially winning the transaction fees and the new coins that are introduced to the system. In all of this, there is no single entity. There is no Bitcoin company, BitDollars company. It's the independent contributions of this whole community. You are all users. You all have accounts. The miners are contributing their power with the incentive in place that they get transaction fees. And as a result, there is no company that takes a cut. It is all independent contribution of computational power or dollars, just for users, that makes this system work. So we've stripped a lot of complexity out of this BitDollars simulation, but congratulations, we all just ran Bitcoin at its core. So hopefully that demystifies a little bit what Bitcoin is. It really is just a spreadsheet, a ledger of who owns how many Bitcoins at any given time and has the alignment of different parties, users, miners, nodes as well, and the original programmers, all contributing without there being a centralized entity. There is no company at all. Some of the things we stripped out were to achieve security, cryptography is what this is all wrapped in. It's all based on the use of cryptography, which has been developed over the last 3 decades, largely by the US military. And these cryptographic hash algorithms, basically what they do is you input something, it does its thing, the algorithm does its thing, and output something that you could never reverse engineer to figure out what the input was. It goes one direction. And the important thing is that if you put in the same input again, you get the same output, even though you have no idea what the input was. So long as you have the same input, it is the same output. That is, in very complicated ways, but a very remarkable ways, the key of perfect security in this system, where over the last 9 years that Bitcoin's been running, every hacker in the world would have loved to hack Bitcoin because they could become a billionaire overnight just by adding Bitcoins to their account. And nobody's been able to do it. And that's because of cryptography. And digital signatures are a part of that too. And so what we managed to do there through the contributions of the miners, mostly, tabulating everybody's transactions based on the set of rules that we've all agreed to by participating in this BitDollars platform. The miners, through their independent calculations, achieved a consensus that we could all trust. So out of this system, out of the design of the system, we achieved trust. And that is the core of blockchain that has a lot of potential to be applied elsewhere beyond Bitcoin. So I'm actually not a huge proponent of Bitcoin. I'm more excited about the real-world applications that blockchain will have beyond Bitcoin. So we'll talk a little bit more about that. So, but the core of this that I hope you take away from the simulation is that through the contributions of independent actors, we've achieved the same result of trust that we need in any financial transaction or any contract execution between counterparties. You need to have trust, and we've just achieved trust through decentralized consensus. So for all of human history, we've had basically 2 ways to have trust in some counterparty that you're thinking about doing business with. You could either know them personally and have, trust their reputation, or you can trust some third party that vouches for them, or is going to be the escrow service where you route your business through. Those are the only 2 ways that we've ever had to create trust in a business transaction. But suddenly, through blockchain, we have decentralized consensus that creates trust through a blockchain system. And the key about this is that it's a fraction of the cost. So without an entity, without a bank, without a credit card, without an escrow service, having an entity that has, has to keep the lights on and make profits, instead of that, we have computers running code, and we just need to incentivize them to make it financially attractive to run some computer code. That is orders of magnitude cheaper to do than to support businesses that are trust intermediaries. So we have trust in a 10x cheaper way. And so ultimately, this is what's different. So today we trust centralized institutions like banks or credit card companies to be the repository, the authority about who owns what. But through a distributed ledger, this decentralized consensus, we trust consensus rather than this authority that takes a nice handsome profit off the top of every transaction. So that's great for Bitcoin, but what does this mean for the economy going forward? Well, we're really still in early days for what blockchain is and what it can do for the economy. Bitcoin is really a proof of concept. It invented blockchain, and I think it will go down in history as one of the most brilliant inventions of the modern era. But the real economic value comes after that, where Ethereum abstracted on this set of rules about how do we agree upon transactions in a decentralized way, and created the concept of smart contracts. So what is a smart contract? A smart contract is being able to write into the ledger, as we saw, instead of who owns what, it's here's a contract for when this and this condition are met, automatically transfer this amount of value. So suddenly we've created a way to do any sort of B2B or B2C contract with the decentralized consensus model, which, as we talked about, is much cheaper because we've disintermediated trust institutions and we trust consensus of contributed computer power, basically. So that's the foundation of what I'm excited about for blockchain, as we'll talk about how this can disrupt the way that business is transacted today. But looking forward, there's still, you're not using blockchain platforms today to route your commerce. Not yet. It's still a very user-unfriendly world. It's hard to get accounts set up, and it's hard to move this money around. You have to be fairly tech savvy and spend a lot of time investing in how it works. And so, really it feels much like the internet did in the early days of the internet. It's very user-unfriendly, but the potential is pretty massive. So I'm a believer, and many other people are big believers, that blockchain technology is actually going to enable a second wave of the internet. We basically have, with the internet today, with the web, these protocols that everything is built on, HTTP, TCP, IP, allow us to digitize information and information exchange, and that's wonderful. We've achieved a lot through the digitization of information. But it's not really good for value exchange. Because of the susceptibility of today's internet to hackers, we don't trust the internet with our value. So we don't store value online. Even when you're using your online bank, you're logging in through a narrow portal to their core banking servers, which are kept offline. But with blockchain and cryptography and decentralized consensus, it's suddenly safe to bring that value online. So we are going to be able to digitize value, and then what comes from that will be a Cambrian explosion that we're already seeing of what are the business models that you can create when you have the world's value accessible online that you can interact with, and do so, and what kind of business models can you create that have the same effect as conventional businesses today, but leverage the cost benefits of a blockchain system to do things 10 times cheaper. So, if there's one big takeaway, it's that we are in 1995 for the internet part 2. This slide is a few months old now, and things have changed a fair bit. But the point here is to call out how there's been massive growth. There was massive growth in 2017. In October, the total market cap of all cryptocurrencies, all blockchain value, was 150 billion. At the moment, it's already up to 700 billion, 800 billion now. Yeah. And there aren't a ton of very reputable estimates about where this is headed, but the former head of the Fortress Investment Group pegged this, a large hedge fund, pegged this at 5 trillion by 2022, and Deloitte estimated 8 trillion in assets on blockchain by 2025. I think that we are heading towards sort of a repeat of the dot-com era. The dot-com era was a $5 trillion bubble. I think we're heading towards a $5 to $10 trillion bubble. But we, luckily, are still in the very early stages of that. At least that's what I'm banking on. So the dot-com bubble was 20 years ago. The internet was not so vital in the economy yet. It was also a regional bubble. It was largely US investors, whereas blockchain is a global market and will have an impact on how business is done across the world. And it's also, in a time when the internet is vital in our economy. And fundamentally, what we're talking about is the digitization of the world's value, which has massive implications in terms of total dollars if that trend occurs. And all indications are that, faster, better, cheaper, in a 10x kind of way, that tends to win. So that's my thesis on the scale of what we're heading towards, and I believe we're still at the front end of it. Yeah.
I had a question come in from online.
Sure.
From Joshua Miller. What is your perspective on the value of EOS and NEO versus competing alternatives?
Okay. Very specific. Yeah, I'm actually a big fan of NEO, but that's probably more specific than we should really get into. But I'll talk about NEO a little bit later in terms of the potential of these platforms.
Sorry, I had a question related to a slide earlier.
Sure.
Regarding the ledger, is 100% consensus required, or what level of consensus?
Great question. Yeah, so right. When the miners are tabulating, they actually only need 51% consensus. So one of the threats to any blockchain is what would it take to have to get a coalition of 51% to commit fraud with you. And that's sort of a metric of how healthy the system is how difficult that would be. That's largely based on the amount of computational power. In Bitcoin's instance, there's about 100 Googles worth of computational power on the system. So to get 51 Googles worth to commit fraud with you in a 10-minute period is very difficult. So that's one of the reasons why Bitcoin is so secure.
What qualifies the miners to be ledger holders? What is the
Yeah, there is no requirement.
Okay.
The only requirement is to run the software such that you are a miner. So you're running the miner software that you're listening to transactions. You're also trying to find the solution to the next block.
Any monitoring of who's running the software?
Yes. Yeah. So at any given time, you can see how dispersed the computational power is.
Okay.
One of the problems with Bitcoin is that there's sort of an economic incentive towards centralization with a few parties, because obviously it's cheaper to run server farms than it is to run individual computers.
And when you have a much more powerful entity assembling the server farms,
Right.
they could control things.
Yeah.
Which is the rumor about China.
Right. So many of the mining operations are located in China, largely for cheaper energy. And it's a major concern. It's one of the reasons that I am bearish long-term on Bitcoin. The two main reasons are the massive energy consumption of Bitcoin. About a month ago, it's probably higher now, Bitcoin was consuming the same amount of energy per year as Denmark. Each transaction equated to the consumption of the average American home over 9 days, which is insane. That's unsustainable. The other problem is there's a poor governance mechanism. There's no clear way to update Bitcoin easily. And so these forks that you may have heard about are a result of schisms in terms of sort of ideological perspectives about how Bitcoin should scale. And those are two giant problems that won't be easy to remedy, and I think could rip Bitcoin apart long term. So different perspectives here, okay. Okay, so going back to where we were. All right, yeah, so what is so interesting about cryptocurrencies, sort of as an asset class, is that they have a different dynamic in terms of where value is captured compared to how value is captured on the web. On the web, all the value is captured in the application layer. The protocol layer is open source. It's open sourced by the US government. These are the set of rules, TCP/IP, HTTP, just simple sets of rules about how servers can exchange packets of information that create the internet. And so there's no value captured there. There's no ownership layer there. So it's impossible to own the protocol layer. What you can own is a slice of an application. So you could own stock in Amazon or Google or Uber or Netflix that are all built on those protocols. But all the value is captured by those companies. And that's how we think of value being captured traditionally is value is captured by companies because they are kind of the hubs of if you want to achieve some sort of transaction, you go to that. If you want to place an ad on the internet, you go to Google, and Google is your one-stop shop, and they take a cut. And that's how business works. What's interesting about blockchain is value is captured more so at the protocol layer, in the sense that all the data is completely open to anybody about, in Bitcoin's instance, any Bitcoin transaction ever is visible online. And so the information about all transactions can be used by any application that wants to come in and use that data. So data lives at the protocol layer, not at the application layer. And that means that and all the value of the trust and security is generated by the protocol rather than the application that is sitting on top of it. So I'm a big believer that in this next generation of the internet, the value sits in the protocol layer itself, hence the name of my fund, Protocol Capital. But to give you a little bit of a visual representation of what I'm talking about here, with the internet today, it's a robust economy. It's a city where each one of those would be Amazon or Uber. And there's a ton of commerce that happens on the web and based on the TCP/IP and other protocols. But all transactions are done in terms of fiat, of dollars or other currencies. So there is no way to take an ownership slice of the protocol layer. You can only own the application layer. Compare that to blockchain. So what a cryptocurrency is simply the ownership layer of a protocol. So you may have heard of Ethereum or Neo. We'll talk about Neo. In Neo's case, if you want to use that platform in order to transact business, so as a simple example, let's say you wanted to sell your house, but you didn't want to have to pay an escrow service, that percentage. You could sell your house through a blockchain platform and achieve all the same trust and security in that transaction that the escrow service would have provided you. But instead of using that intermediary, you're going directly to the counterparty using the blockchain platform as your transaction rails. The only requirement is that transaction be conducted in the currency of that system. So Neo or Ethereum, that's the currency that has to be executed in, which means that you can, and since there's a fixed amount of Ethereum currency, Ether, 100 million about, it's possible to take an ownership slice today, an ownership stake in the currency of what is essentially an economy. So for the first time ever, it's possible to take, because of the early development of these platforms today, it's possible to take an ownership stake in a Series A, Series B stage maturity economy as it grows. And I think that's a never before seen asset class and pretty uniquely attractive from an investment perspective. If you believe that there is an advantage to doing things 10x faster, 10x cheaper, faster, better, and that businesses over time will prefer to not use that escrow service or not use that credit card that takes 2% and takes 3 to 5 days to process, but instead use a cryptocurrency that is more or less instant and takes a tiny, let's say 0.1% fee instead of that 2% fee. So that's why this is a very interesting asset class and one that I'm very excited about. So many of you are business people, and it's important, I think, to consider the ways in which this disruptive technology can change your industry and either disrupt you or give you an opportunity to harness it and disrupt incumbents in your industry. There's also considerations as individual investors, which is mostly what I focus on, but oh, I didn't know this was animated. Cool. So I think if you're going to consider what are the ways in which blockchain might affect my business, I think the two important dimensions is network value in your industry, and the extent to which trust is essential to your business model. So in the high chance of disruption, banks, credit cards, and increasingly venture capital. So many of you have probably heard of ICOs, which is essentially a blockchain-based way to raise venture money directly from individual investors. So it's sort of like Kickstarter for equity. And that sort of disrupts, or at least threatens, the venture capital model of being a network hub that brings together companies and investors. So if you don't have to go through that network hub and you go directly to, if an investor goes directly to the company raising money, well, you've disintermediated venture capital. So those are important considerations, but of course there are some industries where blockchain will have less of an impact, like retail. So as investors, there are many cryptocurrencies. It's hard to invest today. It's technically a little challenging. And there are thousands of cryptocurrencies, and it's hard to choose which are the ones that have a bright future. That's basically what I do, is research what's happening with all these different technologies and the ecosystems that are building around them. And that's kind of the fundamental metric of future value, I believe, for a platform, is the robustness and rate of development of the ecosystem around it. But it's hard to know which ones are doing that. Also, if you were to invest equally in every single one of those 2,000 cryptocurrencies, you'd actually make negative returns. You'd lose a lot of money. So like many industries, there's a long tail of underperformers, and just a few platforms do exceptionally well. So considerations as an investor, but a very exciting asset class overall. So the key points that I want to reiterate, and then we'll do just a Q&A, and we can have a discussion about anything you guys want to talk about. What is blockchain? At its core, it is trust via decentralized consensus. That is the fundamental unit of blockchain, and a remarkable development because it, for the first time, gives us a way to transact business that's not relying on personal relationships and reputation or a third-party intermediary. So that is going to be a massive macro trend that plays out over the next 10, 20 years as these platforms build out and commerce starts to shift to these transaction rails in place of traditional routing. The result of that will be the internet of value that we're heading towards quickly. That being said, I think valuations are getting ahead of where they should be, and that will continue as we head into a massive bubble. But I believe we're still in the first inning of that bubble. An important point here is that value is captured in the protocol layer. So this concept of the FAT protocols that is different from traditional ways of doing business and how we conventionally think of investments. Value is not going to be captured in individual companies in this space. It will be captured in the protocols that are the bones, the foundation of this internet of value, and where all the value is generated in terms of decentralized consensus and security. And then finally, we should all be aware that blockchain is going to disrupt many businesses, many industries, by disintermediating trust institutions and enabling business models that allow you to do the same, have the same effect, but with much lower operating costs. So that's the conclusion of what I wanted to talk about. So any questions that we all have, and let's be mindful of the mics so that everybody in the other room can hear us.
Well, recently I think Bitcoin was like $16,000 for a Bitcoin, $16,000.
Yeah.
So let's say I bought in at $16,000, and does that mean that I've got $16,000 US dollars worth of purchasing power? Because if it goes down to 10, now I've got 10. I mean, the whole thing. But what if I bought 15? Could it go down to 10 before the 15 had expired? You see what I mean? How you're kind of getting a negative there?
Yeah, there's massive volatility in the space, and Bitcoin is interesting. Ultimately, what Bitcoin's use case is to be digital gold. So the goal is to be a store of value for the digital era, and it's very good at that. But it's still very early days. So most of the value is driven by speculation, and the volatility is a result of that speculation. And so if you buy one Bitcoin and it's $15,000, you're essentially storing $15,000 worth of value in Bitcoin in this ledger that lives nowhere and everywhere at the same time. And it can go down to 10,000. So in that sense, it's not the best, not the most stable store of value, but it's not subject to any one entity holding it. So you've reduced your risk dramatically in terms of will I be able to take this value out later? Because there's no entity. There just have to be some servers running Bitcoin all over the world for your Bitcoin to still be valid. And there's the perfect security of cryptography that makes it so that you know that you'll be able to take your value out without it being stolen unless you forfeit your private keys at some point. But currently, it is subject to a ton of volatility. So I think that as Bitcoin matures, the volatility will decrease. It's already approaching gold's level of volatility. And we believe gold is a perfectly reasonable store of value.
Jesse, I have the mic, so I'm going to ask a quick question.
Yeah.
To build on what John asked, if John wanted to go out right now and buy one coin,
yeah.
Can you describe, because I have a feeling there's a number of people in the room,
right.
How does one do it?
Yeah.
And how does one, like what exchange do they use, what credit card do they put in, like how do they actually buy a coin?
Yeah, it's a great question. It's surprisingly hard. Coinbase is kind of the first name in this process. they have made it as easy as anybody at this point to buy a small amount of Bitcoin. I believe just with your credit card on the spot, you can purchase some Bitcoin and it gets put in escrow for a few days and then you get your value. That's one way to do it. You can also set up an account with, there's a number of sort of E-Trade style exchanges that are dedicated to cryptocurrency that you can, once you've set up your account, like these are like Kraken, Gemini, GDAX, you can wire in dollars and then on that market exchange dollars for Bitcoin, and then it's in your account there. It's kind of a pain in the butt to set those up, but that's how it's done today. Coinbase is the easiest currently.
For newer cryptocurrencies, when you're evaluating them, what are the top 3 metrics you're looking at to indicate a growing supportive community that might trigger its positive?
Totally, great question. So most importantly is the quality and excitement and rate of change of the ecosystem around it. It's a completely open source community. So all these projects, you can read through their code on GitHub. You can go through all of it. And they keep their Slack channels open. They want people to come ask them questions because they're trying to attract developers to come build on top of their platform. And the only way to do that is to be really open. And so as a result of that, this information lives on forums and in chat rooms. It's a digital native market. And so combing through those resources and articles written by, code audits written by very technical people, but then also perspectives from business people who are starting application built on that protocol and why they chose that protocol. You start to triangulate how excited is the developer community and the broader community about this platform and its pros and cons relative to others. That's the #1 metric that I use to judge the future of a platform. But also the specs of the tech. So Bitcoin is, for a while it was 3 transactions per second. It's now 7 transactions per second. That's very limited. Visa averages about 2,000 transactions per second. Ethereum is, I think, 15 transactions per second with plans in place to increase that dramatically. Neo is already in the 1,000 transactions per second scale. I sort of think of those 3 as first generation, second, and third generation platforms. The third generation, I think, is building on a lot of improving the weaknesses of earlier generations and more focused on integrating with enterprise. And I think that will drive a lot of adoption in terms of businesses being able to leverage the economic benefits of routing transactions through a platform and saving all that money. And I think that's going to be where the needle really moves with blockchain adoption. But yeah, so ecosystem, the specs of the tech, and sort of the roadmap and the history of executing on that roadmap, I think is a core way to understand how good are these developers and how clear is their vision and how capable are they at executing on it.
If there's about 2,000 cryptocurrencies currently, is that what you were saying?
Yeah, it's changing a lot.
Do you think it'll expand and then contract down to just a few over time? Or
Yeah.
what do you think will happen?
Great question. I should clarify with that there's a broad tapestry. There's a landscape of different use cases that cryptocurrencies are being used for. There's very few that are protocol layer cryptocurrencies. And what they're intending to be is a platform, the foundational element for where applications can build on top of. A lot of the cryptocurrencies are from apps, from startups that have built in a cryptocurrency into their business model, but really they're profit-seeking companies, they're startups. the protocol layer is not profit-seeking. It's a different sort of model. I think that the vast majority of these will fail. Easily 90% will fail, and fail dramatically over a 5-year horizon, probably. Similar to the dot-com era, possibly more dramatic, even. But I think that there will be quite a few Amazons that are even in existence today and then continue to grow in economic importance through that period.
I have a couple questions from the other room. The first was, other than computational power, do any of the cryptocurrencies have a built-in safety valve for the 51% rule?
Yeah, so there's been a lot of experimentation with what's the consensus mechanism, as it's called. So proof of work is that 51% computational power model. And that's what Bitcoin's based on. It's very secure because the only way to falsify it is if you have convinced 51% of the computational power on the network to commit fraud with you. There's now a shift towards proof of stake models, and then experimentation with a number of other models beyond that too. Proof of stake is in essence allowing the holders of the currency to vote proportionally based on how much currency they own, to sort of have delegates in a sort of a Republican sort of way of, rather than a pure democracy of everybody voting on everything, you're nominating somebody to be your delegate based on how much voting power you have by holding coins. So there's a lot of experimentation with that. The proof of stake model is much less energetically demanding and wasteful. So I think that there will be a shift towards that in the future.
Then another question from the other room. What non-financial transaction is blockchain useful for? And an example, please. So either speculative
Sure.
example or maybe an existing example.
Okay. So I'll talk about two very different things that I think are really interesting applications for this tech. And ultimately, they're value transactions, though. So in one case, we have supply chain. So the way the supply chain works today is basically, the conventional internet system where you scan in your barcode, and that represents a certain SKU and what this item is, and in theory where it came from. But that's pretty hackable. You could replicate that SKU, and it's harder to be completely certain about authenticity with today's model. If you were to apply a blockchain, you can give each and every inventory unit its own private key that's impossible to crack, such that when some inventory arrives at a warehouse and they scanned it in, they could see, oh, this unique private key is in the ledger. It's in the blockchain for this inventory system. And we know every single place that it's been with perfect authenticity because of the private key that it's tied to. So that's a much better way to do supply chain management, and will decrease dramatically the amount of counterfeits that creep into the system if you apply this sort of model. A totally different example of how blockchain can be used, one that I think is really cool, is tokenization. So there's a particular startup called Artstock that's trying to trying to allow for IPOing individual pieces of art. So today, if you wanted to own a Van Gogh, you have to have $100 million available to purchase that Van Gogh. And so the art market's valuations are based on the demand of a tiny, tiny slice of the population. If you were to IPO that piece of art, that individual Van Gogh, slice it into 1 million ownership shares, and then have those ownership shares tradable, you create a ton more value because suddenly all you need is $10 or whatever amount it is to own a little bit of that individual piece of art and have exposure in your portfolio to art, to high-end art, and all the characteristics of that pretty interesting financial market. So suddenly that's possible through tokenization, and that's only possible with blockchain because of the security that it provides in allowing you to IPO with a very low cost. So you couldn't do an IPO for Van Gogh today because it'd be prohibitively expensive to have those shares, and who's going to manage all that. But with this technology, you can do that very cheaply.
So, two-part question, kind of how you would put money into a cryptocurrency.
Yeah.
Like, one would be to put actual, like, get dollars or some real currency.
Yep.
And buy a piece of the cryptocurrency. And then I assume the other one would be to invest money in companies that are creating the tech that runs the cryptocurrency.
That's right, exactly. So there's sort of two approaches here, is to invest in the currency itself. Ultimately what you're doing, let's take Ethereum as an example, the forerunner of smart contracts platforms. Let's say you bought 1% of all the Ether coins in existence. Today, Ethereum's valuation is like 90 billion. So it's a big chunk, but let's say you bought all that. What you're investing in, the speculation that you're making, is that as businesses start to route their transactions through Ethereum's platform, the total demand for that currency will increase, because if we wanted to do, if I wanted to sell you my house, but I wanted it in Ether terms, you would have to have $1 million, let's say, of Ether in order to buy my house, and that creates $1 million worth of demand, right, in that one transaction. So what you're banking on is that even though the supply of Ether is fixed at 100 million, the demand will grow, and therefore the value of that pie will grow, even though your slice remains 1% of the total pie. The alternative approach is to invest in companies, to take equity in profit-seeking companies that are going to leverage blockchain as part of their business model. So in the art stock situation, they would take a fee off of any IPO of art, and that would be their business model. So you take an equity stake in art stock, the company, without ever owning any of the currency. Those are the two approaches. I've noticed that venture capitalists tend to stick to that equity approach. It's what they know, it's what they're really good at, it's the deal flow philosophy. But I think that this new market of being able to own the protocol layer for the first time ever is what I'm excited about, and so I index towards holding the coins. How you would actually get dollars into the market, so if you were to do the Bitcoin purchasing step, you then need to trade Bitcoin for whatever currencies you're trying to buy. Bitcoin's kind of the gateway to all the other currencies. And you could buy any currency that's traded once you have Bitcoin, so that step is pretty easy.
I think there's also a lot of people that don't understand the difference between an actual cryptocurrency and a token that's issued like on Ethereum's blockchain that represents a possible future currency.
Yeah, this is kind of a complicated topic. Suffice to say that there are, so Ethereum and Bitcoin well, Bitcoin's a true currency, and it's a store of value focused currency. It's not a transaction focused currency. Transaction fees are now $20 to transact on Bitcoin, so you can't really buy a coffee with Bitcoin anymore. There are also transaction-focused currencies. There are then also smart contracts platform currencies. So the Ethereum example of businesses starting to use that platform to route their commerce. leading to an increased value of that currency pool. That's based on smart contracts. Tokens on top of a smart contract platform are sort of their own little, so ICOs, basically venture funding through peer-to-peer fundraising. So this is the example of why venture capital is now under a little bit of threat in terms of there's a new model in town for how companies can raise money. And by purchasing tokens in that company, you can be purchasing rights to any number of future things. You can be purchasing rights to a currency in the future or to even equity in that company. So those vary quite a bit, but that's what an ERC20 token is, a Ethereum-based fundraising model. Yeah.
How do you explain, or do you have an explanation for the fact that Bitcoin, for example, has been fairly low valued for quite a long time?
Yeah.
I know a lot of people, including my son, who kind of threw out a hard disk with the Bitcoin because it was not worth it. And so why all of a sudden, not too long ago, was this kind of spike of this going up?
That's a great question. I don't fully know. I think the origins of Bitcoin, was in the wake of the financial crisis. That this mysterious creator, Satoshi Nakamoto, wanted to have a system outside of banking, basically, that you could have a store of value in a currency that lives outside of banking. And it was for a long time at the very technical, tech anarchist fringe of society, and then sort of made its way towards crime, and purchasing drugs on the dark web was its main use case for a while. But that was years ago. And then as more and more users are attracted to this system, sort of the valuation of this network follows the Metcalfe's law in terms of the values driven by proportionate to the square of users. More and more users came along, and the legitimacy of it sort of grew. The computational power on the network became such that it was really genuinely secure. It's hard to argue with 100 Googles worth of computational power when they all agree that a transaction is valid. And then I think there's just an element of society wasn't really ready for digitizing value, and we're only just now getting to that point where we're at a tipping point where it's going to start making sense. If you think about the internet in 1994, 95, it was like, yeah, you understood that email was valuable, and there was this possible promise of e-commerce, but it wasn't here yet, and suddenly, all of a sudden, it all happened. And I think we're following a similar sort of sea change in terms of how society understands value and value transactions.
I'm just going to interrupt quickly here. We have time, I think, for 2 more questions, and I know there's a question right here in the corner.
Thank you. So I really appreciate this is a very challenging topic.
Yeah.
And you're covering it in a lot of different complex ways to an audience that's probably new to it for the most part. So good job. So I had one thing I wanted to say is that Coinbase, I wouldn't necessarily recommend it. If anyone wants to talk to me later, I can provide you some other recommendations.
I also agree.
For a variety of reasons, and it's not a bad company, but we can talk about that more offline. And then I just wanted to ask, so you mentioned a couple of your, I guess, criticisms, for lack of a better word, of Bitcoin.
Yep.
Energy consumption, the protocol issues, the forking, stuff like that. And I'm curious, though, because it's the largest and strongest, and you just talked about the security of it, network, how you might see these other sort of competing networks or coins doing differently without the same level of problems of scaling, energy consumption, protocol issues, and the like, because Bitcoin has been around for a long time and it's scaled to a very significant level, and that's why it's having some of these challenges, which I could also talk about offline and refute some of them, but I'd just like to hear your answer.
Yeah, I think that it's quite possible that Bitcoin will always be the best store of value. I think that's quite possible. Bitcoin was a flash of lightning, just brilliant moment of innovation that got so much right in its genesis. But how was he to know that it would scale to this level of energy consumption, or that it would be? In the early days, they talked very openly about we will increase the block size when we need to, and that'll be no problem. But now we've seen that without a clear mechanism to force that, it creates rifts it becomes politicized, and these different parties are trying to hijack control of the spirit of Bitcoin, and so I think that those are hard to fix.
Decentralized network.
It's a decentralized network, but some of the later iterations, these newer generations, have made efforts to implement governance mechanisms that force decisions and even prevent forking. NEO actually prevents forking, even though it's a smart contracts platform. So I think that there's a world where, in a long arc here, that the ability to make updates wins out over a static, essentially static, or at least high inertia technology platform. But in terms of network, it's fantastic. The robustness and number of users and the amount of computational power is hard to argue with. And I'm optimistic that the Lightning Network will resolve a lot of it. But funding channels and all that will be another difficult challenge that they still have to figure out, and then they're still scaling. So Bitcoin is the incumbent, and it's their advantage to lose. But I could see a world where it happens.
Jesse, we're just going to take one more question,
Yeah.
because I know, and there will be time afterwards if you didn't get your question asked. I think Jesse's going to stick around afterwards.
Yeah,
and
sure.
And personally answer some of your questions. Last question, Lauren.
So I have a bunch of questions online. I'm hoping I can
Okay.
email some of them to you, and I'll get them
Sure.
answers offline. And
Yeah.
I'm just going to pick one winner, which is, what do you think about blockchain stocks, like Riot Blockchain or blockchain futures?
I don't know Riot Blockchain. You're actually more qualified to talk about
Probably could.
futures than I am. So for everybody, futures is a recent development in Bitcoin. It's as of about a month ago.
December 18th on the CME and December 8th on the CBOE.
Yeah, it's now possible to trade futures, which is a vital instrument in conventional markets and has been something that Bitcoin hasn't been exposed to before, which should bring more sophisticated traders and interesting forces to stabilize Bitcoin ultimately.
Absolutely. Yeah, if anyone has any questions about the Bitcoin futures contract, they can talk to me afterwards as well, because it contrasts a little bit with what you're
Yeah, I know very little about futures.
I'm going to cheat, though. I said last question from Lauren, but I'm actually, because I have the floor and I'm the fill-in MC, I actually have one last question. This is really, really important. And this is being videotaped, so you have to be really careful with your answer.
Okay.
And I know that when you agreed to speak, that this isn't a plug, but I'm going to give you the opportunity. Because I'm a fund manager, I know what it's like. I'm going to give you the opportunity to just tell everyone a little bit. How does one invest in a fund like yours?
Okay, I see. Yeah, so I run a fund. It's a crypto hedge fund in the sense that it's most like a traditional hedge fund of any sort of investment vehicle. I take positions in coins. I hold coins. It's long only. In the platforms and currencies that I think have the brightest future, the most chance to appreciate in value. So it's a fund that I run out of San Francisco. We can talk if anybody's interested in investing. There are some thresholds. You have to be a qualified client. There's a 100K minimum.
And they can find your information online?
And my, my information is there.
Excellent.
If anybody wants to email me, I will also be here, and I have cards too, so we can exchange that information.
Fantastic. That's very good. Thank you very much, Jesse.
Thank you, everybody. Thank you very much.
Just as we wrap here, I think the last time I checked for anyone that really cares is Georgia's ahead by 20, up 10 on Alabama. But the last thing I'd like to do is just thank everyone for coming tonight, and secondly, to thank our volunteers. We have a great group of volunteers. As Johannes mentioned earlier, we have Rachel, Garrett, and Ellen, who are our old standbys, and then we have Dan and Rory on the TV program here. And then I think, Rachel, if you're out there, is Rachel out there by chance? Rachel? Can you come in here for a second, please? I just want Rachel, if you could. Rachel, can you just announce your two newest volunteers? I noticed there were two people I didn't know, and I put you on the spot, but do you remember who they were?
Yes, of course. So we have Josh Miller, he's our new sponsor coordinator, and we have Suzanne Sullivan, and she's going to be doing all our accounting. And so you probably remember a couple of meetings ago, we asked for volunteers, and we're so glad that they came our way, and we have the extra hands. It takes a lot of work and effort to put these all together and run this, so many hands make light work, and definitely if you are interested in volunteering, let me know for sure. We're happy to have you.
Thanks very much, everyone. Thanks for coming. Good night.